it is. Okay, folks, we'll go ahead and get started. I'm Mark Trice, founder and lead advisor of ClearVista Financial. With me today is Jesse Hamilton. He's a fellow financial advisor here at our office.
Welcome.
So this is the July 24 market update. A lot of news has come out in the last few days we're going to share with you, but we'll go through some of our typical reporting things that we do, just kind of tell you how the markets are doing this year.
Yeah, so we made it halfway through the year, Mark. Does it seem like we're halfway there?
It gets faster and faster every year, Jesse, and you'll find that with your newborn.
Yeah.
Pretty soon she'll be out of the house.
Well, we will cover June performance. As usual, we'll look back at the previous month. We'll also talk about what's happened this year so far, all 6 months year to date. And of course, we'll make our comments on the state of the economy. We'll talk about the Fed. Jerome Powell testified yesterday with Congress, and we'll talk about what he said, what it could mean for interest rates. And of course, we'll revisit the whole presidential thing happening right now.
Yeah.
And how it affects the markets.
So you can interact with us, folks, in today's program. You can text us at our secure text line, 254-282-0495. Or send us an email at info@clearvistafinancial.com. We'll try to answer those on the program today. If not, we'll get back with you within 24 hours. So, Jesse, let's kick things off with kind of a review of how the indexes did.
Sure. Let's kill the camera so that they have a little bit more real estate.
Okay. All right. I'll do that. Freeze that.
You should be able to see everything now. So as a reminder, we like to show these charts. They're called candle charts. Each day is a candle. Each candle is a day. Red candles are down and green candles are up. Here's the S&P 500, which is our large cap index in the US. It had a pretty smooth run up in June, 3.41%. And we had a small gap up there, which was nice. And we held that gap and continued up for a few days. And these prices surpassed the previous highs in May, which is a positive trend. And large caps performed well, despite some continued hesitation from the Fed about interest rates.
Okay.
Here's the NASDAQ 100, which is our tech-heavy index. It's similar to the S&P, but it's heavily weighted and influenced by those mega cap companies. The Magnificent Seven, which they have now changed to the Fab Five, or the sort of Fantastic Four. But this index closed up 5.96% in June, and that moved past the losses from April. And we'll talk about what happened here in a minute, but it was really a combination of earnings and artificial intelligence excitement that allowed these tech companies to shine.
Okay. What about small caps?
Small caps were actually down in June. So we talked about the large caps being up so great. We're seeing a continued divergence between the two. The small cap index was down 1.4 and trended down for the first week of the month. You can see the first couple candles, the price continues down, gapped up, and then it really didn't recover for the rest of the month.
So that divergence between the large caps and small cap companies is a concern amongst technical watchers of the market. And we'll talk about that in just a moment a little bit further.
We'll compare it in multiple ways. And then lastly, we take a peek at the long-term Treasury index. These are long-term bonds issued by the government. And it was actually up 1.47%. But you can kind of see the last day of the month was this big red candle. Investors were leaving this index and moving the price down. So a positive return is good news, despite volatility. And it's another positive month this year in the long-term Treasury index, but it is down year to date. We'll talk about that in a few minutes, but it's lost quite a bit.
So when you see the long-term Treasury index go have a gain a month, that means primarily yields probably fell a little bit during
Just
that
a tiny
month.
bit, yeah.
Yeah. Okay. And here's our disclosure.
Take a moment to
Take
read
a moment
these
to
in
read
great
this,
detail.
memorize, or will be a quiz at the end of today's program. So make sure you know what all these different indexes mean. Okay, jumping ahead, Jesse.
So here is our comparison chart between the S&P 500 and the Russell 2000. The large caps are in green and red, and the Russell is in blue. And we can see how they started to diverge in 2021, and they have not come together since. But we had a few periods where the indexes tried to come back together. And like I said, in June, they continue to go further apart because the large caps are just, they keep going up and the small caps do not.
And we see this, and this is just giving us an indication, and Jesse's got some slides in here in a few minutes to address that. Just means that the overall market is, there's not a lot of breadth to the rally that we've had this year.
Mm-hmm.
And so until we see that breadth, we'll probably see the market continue to struggle, or returns will be focused into just a few sectors. I know last time we showed a chart, I don't think it's in here this month, we showed a chart how of all the gains on the NASDAQ and the S&P 500, it's been 4 or 5 companies that pushed it up, and the rest of the 495 or so, the S&P 500, are flat or negative for the year.
That's
and
right.
So that trend continues. That just means that investors are focused on 1 or 2 particular sectors. Okay.
So my next chart here is, it's the same thing, but it's a different way to look at it. So this is a large cap, small cap comparison. What we want to look at is the black line. When that line goes up, large caps are outperforming compared to small caps.
Okay.
And you can see the general trend over the past year is up, which means large caps are winning. Briefly in November, you can see the peak towards the center where it dips down. We had a short period that favored small caps, but then it quickly reversed and continued up. So we really want to see this even out. And as long as this black line keeps going up, we're getting further and further away from market breadth.
Okay. So it's a little bit different way of looking at things. What about this next chart?
Here's a chart that shows the percentage of stocks that are above their 200-day moving average, which is a generally recognized sign of strength and bullishness in the market. This is a 1-month timeline, so it doesn't give us a whole lot of perspective, but the indicator just kind of moves sideways. And after taking a dip in April, June's high was just below 60. But what we want to see is this number stay above 60 and maybe even hit 70 or 80. And at the end of the month, it was at 50.
So it just means that 50% of all the stocks on the stock market in the US were trading below their 200-day moving average, which is a sign of weakness overall. Now, it's good that we're in the 50s. You know, back in the early part of October last year, at the end of October, they were in the 20s. So the market has improved. The market breadth has improved, but it hasn't made that final push to have an indication of a very strong market.
Here's the same chart over the entire year to date. So this goes back to January of this year, and you can really see the sideways movement. There really hasn't been much activity going on, and it doesn't show preference one way or the other.
Well, I actually, Jesse, I kind of see this here. I'm just going to draw a line here, but if I draw through the center point of this line, sorry, it's not straight, folks, but it's generally kind of a downtrend. And that should be something that we should pay attention to, and to see if that continues. Hopefully it'll improve. The last couple of days and the first part of July, that trend has begun to turn up again.
Right.
So hopefully we see this. So we've talked about before the different things with bear market recoveries. We generally have recovered from those things, with the exception of really the moderate portfolio index and really the long-term treasuries.
Yeah, so these are actual year-to-date numbers from January 1st to June 30th of 2024. The NASDAQ is the clear winner here, positive 18%, because of the AI hype and people jumping in, and big investors, small investors thinking that AI has the power to change the future and putting money into these stocks.
And I should say something here, because some people get confused and say, wait a minute, if the NASDAQ and the S&P are up so much, why is my portfolio, maybe your 401k, is not up as much? And that's because you probably own, hopefully, a diversified portfolio a number of different investments in different sectors and things. And what you're seeing is it's really only been tech that's been driving any of the indexes.
And not just tech, but about 5 companies.
5 companies in tech that have really pushed the indexes up. The indexes are cap weighted. And that means the size of the company has a larger influence on the index than a smaller company that may be doing the same thing, but their market cap may be trillions of it compared to a few hundred million.
And just in comparison, folks, the largest company in the NASDAQ, which was just announced, it's changed recently. You all know who it is. It's a large chip maker that's doing really well right now. That single company has a larger market capitalization than the entire small cap index. So all 2,000 companies on the Russell 2000 combined are smaller than the one company. That's the kind of divergence we're talking about here.
So the NASDAQ recovered from recovered, that date's still wrong, Jesse, you need to fix that. It recovered in October or November of this year. The high was back in 2021 that has recovered. The S&P 500 recovered this January from its bear market. The long-term treasuries, they're still down 9% year to date as of the end of June. And since their peak in April of 2020, that was the height of COVID, they're still down 47%.
Yeah.
And many of you are holding a large portion of bonds in your portfolio because you're following modern portfolio theory. Those still have not recovered.
The moderate portfolio index, which is kind of a moderate benchmark for people, is positive 4.28%. That's more of a modest return that you may or may not see compared to your performance. But what's painful, Mark, is the since last peak number. That index is still down 6.5%.
Yeah. So the equal weight index, which is a spreading of the weight of the different components of the S&P 500. That means think of the Senate. Every state gets 2 senators. S&P equal weight. Every component gets one vote, and it's different from the cap weight. So you can see the difference there. It's almost between the S&P 500 and the S&P 500 equal weight. It's almost it is a 10% difference in performance.
Well, funny enough, Mark, I don't have a chart on it, but the S&P equal weight, the price at the end of June goes back to the end of February. So we have not moved anywhere since February.
Okay, that's good. All right, let's jump in. A reminder, folks, that you can send your questions to 254-282-0495. That's a text line. You can also call us. Just don't call us during the program because we won't answer the phone. And then you can also send your messages to info@ClearVista Financial. We will respond to those sometime during the program or later today. So let's talk about the economy a little bit and the interest rate environment. I think that'll give us some perspective here.
So here's our buddy Jerome Powell. What did he say?
Well, in June, the Federal Reserve decided to keep rates steady, not do any cuts. And their approach is based on their forecast that inflation will continue to move lower. And it's more of the Reagan mantra that President Reagan had about the Soviet Union. It's like, and building relationships. He said, trust but verify. On that time frame back in June, the Fed held their rates steady and offered really little evidence that they were prepared to begin lowering interest rates soon. Canada and Europe, a couple of them cut rates.
So the big players around the world are cutting, but we're not. Right,
but they're also, I don't think they have inflation under less control than we do. So we're looking. The Fed said they're looking for something that gives them confidence that inflation is moving substantially down. And he used the word confident or confidence about 20 times. So that was the magic buzzword. If you're playing along at home and you have a drinking game or something, confidence was the word for that. Now, Chairman Powell just recently testified this week on Tuesday and Wednesday in Congress.
He wasn't in trouble. This is like a normal thing.
He comes up to Capitol Hill about 4 times a year.
And I told you yesterday, Mark, these politicians are really good at their jobs, but they're not financial experts. Yet
No, they're
they
not.
claim to ask questions like the longevity of the yield curve and the unwinding of the balance sheet that they don't really understand.
No, they really don't. Especially the guy who was concerned about us putting too many naval assets on Guam, afraid that it would tip the island. Okay, I digress. So, Federal Reserve Chairman said this week in Congress, he believes that inflation is receding, but here's that word again, isn't yet confident that price gains are sustainably slowing towards the central bank's 2% goal.
Mm-hmm.
So the question is, are we sufficiently confident that it's moving towards 2%? And as of Wednesday, he said, I'm not prepared to say that. And so he said, yes, we have seen some modest further price decreases, but not across the board. He got questions about the Treasury, the Federal Reserve balance sheet, and they've got more work to do that. They said they made a lot of progress, have a lot of way to go.
They still have, they reduced it by 1.7 trillion, but they have a long ways to go.
That's right. And the Federal Reserve balance sheet ballooned up during COVID because of a number of different things. One of the things that I thought was interesting that Chairman Powell mentioned was, and he's kind of starting to shift the blame a little bit from the Federal Reserve to Congress.
Mm-hmm.
One thing that's keeping inflation high is that we continue to spend crazy amounts of money at the federal government. And this is a problem. And unfortunately, neither presidential candidate, or I haven't seen very many congressional members as well, are even remotely concerned about fiscal control. It's turn on the printing press. And that is causing interest rates to stay and inflation stay a little high. So, Jesse, there were some comments about banking rules and stuff like that. Do you want to say anything about that?
Yeah, he just reiterated comments that he made to the Senate Banking Committee the day before, that regulators are actually agreeing to change their plan that forces big banks to hold more capital. So this is a really big win for Wall Street banks. And this revamped version of their proposal could have forced big banks to hold as much as 19% capital to avoid things that have happened recently, but they're undergoing discussions to loosen that. And of course, Congress was very concerned about that.
Of course, loosening the amount of reserves that you have to have at the bank means that you can lend more money,
They
which
can make way more money.
Causes the economy to grow and inflation to go up again. So they don't know what they're doing, folks. I'm sorry. I don't mean to be cynical about things, but I think the comments that Chairman Powell has said, both when he was testifying in the Senate and testifying in the House the next day, they really don't know what they're doing. This is so unique of a situation. They're not sure that they should cut rates at all because of how much money has been flooded into the market, into the economy. We have manipulated our economy for decades, and it only got worse during the COVID era. And I don't think that, and it's a hard job as an economist. I mean, I know these decisions that they have to make. I understand what they're trying to look at, and they don't have sufficient data to make a reasonable decision about these things. So they may drag their feet a little longer, although today inflation data came out.
This is actually the May data.
This is the May data. Did you put
Yeah, we just got the new data today, actually, which is the next slide.
Okay, let's go ahead and jump to that because it was flat in May. And in June, inflation actually, the month over month change was slightly negative, and we're back at the 3% rate again.
Mm-hmm.
So if you look at the core prices, which is what the Fed really looks at,
that's the yellow line there.
The yellow line on the chart here, it only rose 0.1%. And that measure is the year-over-year inflation of the core. This is minus food and energy is 3.3%. The overall inflation rate was 3% for the last 12 months. Now, food prices are still going up. And I think that's important because that's impacting the average consumer.
I eat food every day. Do you?
I do too. And I've got to feed several teenagers, and it's getting more and more expensive. Inflation is beginning to slow down its growth rate. Okay, let's be clear. It's beginning to slow down its growth rate. But Jesse, I went after today's consumer price index report showing that overall 12-month inflation had dropped.
Which, if you pull up the Wall Street Journal right now, it'll say like rate cuts incoming, positive news.
Yes, and so the markets, I mean, the media is spinning this in a way that they shouldn't be spinning it. But Jesse, I said, you know, I'm curious to know what it was a year ago. So that today, the data was released that the overall consumer price index had changed by about 3% over the last 12 months.
Right.
Okay, so I went and pulled up June of 2023. You know what the trailing 12-month consumer price index had changed year over year for 12 months and from 22 to 23? 3.0%. Exactly the same.
Exactly the same one.
A year ago, we've got exactly the same inflation. Now we've had some fluctuations, some ebbs and flows in that, but we're exactly where we were a year ago. So inflation is not cooling off as fast as we thought. It's still rising every month. And the things that are important, like food, are still going up. Shelter is still going up. It rose 0.3%, and year over year is still up well over 5%. Shelter costs. Well, we have to live, we have to eat. If I had to look at the food cost, they're up over about 2% year over year. 4.1% is energy. And one of the things that brought the overall inflation down a tick this month is the price of commodities, energy commodities, gasoline, fuel, and things. And I think that's manipulation in the market, because what we're seeing is two things at work here. Number one, in the late spring, the White House released more oil from the Strategic Petroleum Reserves. If you go to the Department of Energy website, they don't even talk about it. And they haven't talked about any of this that they did during COVID. So the market's being manipulated a little bit there. Prices will fall. And the second thing, which is more concerning to me, is the demand. And so when there's not sufficient demand, prices will fall.
Basic economy.
Basic economics here. So don't get so excited about the headlines. I'm not saying it's bad, but the fight to bring down inflation is nowhere near over. Okay, enough about, I'll get off my soapbox here.
Here's a nice map that I found of who's feeling inflation the most. And Texas looks like it's right there in the middle, no pun intended. And California, Tennessee, and then the Northeast is feeling the highest.
Why are they? What? It's the left and right coast. Oh, I get it. So yeah, Bloomberg created this. Looks like inflation in the flyover states of the West are not so high compared to the left and right coast.
Yeah, the Rocky Mountain region is getting a break for some reason.
Yeah. All right. So some commentary here. The progress is still improving, but it's still above 23. We're about the same as where we were before. Like I said last month, even if inflation were zero, the month over month inflation were overall zero for the next several months, we would still not be that 2% near that 2% target. Okay, so we gotta keep an eye on that. So
we got some jobs data though in June.
That's right, and that's showing a milder job growth, which is one thing that the Fed is looking at. If the economy begins to cool, that might be a reason for them to cut interest rates. Now, this is a double-edged knife here, a double-edged sword, if you will, because if the Fed starts cutting interest rates, historically, that's going to create volatility in the stock market. Okay, that's a negative thing. A positive thing is that borrowing cost may be lower, and that would stimulate the economy more, maybe create more jobs, people buying more houses and things. And so there's a plus and a minus here. Like I said, a double-edged sword. You can benefit. You also can be hurt from that. The unemployment rate did tick up in June to 4.1%. That's still really low. Full employment is considered a 4% unemployment rate. So we're still a strong job market, but it is beginning to cool down a little bit. We're seeing continuing claims tick up a little bit. And, this could be a sign that the economy is cooling a little bit and the Fed's looking for those things. That's why I say it's so hard to be a Federal Reserve economist. They have so much data. I can imagine the arguments that they're having right now amongst themselves because there are lots of different reasons of why they could cut rates, why they shouldn't cut rates. It's a hard decision.
So there was a distinction on the last slide, Mark, between the unemployment rate going up and jobs being added. So that doesn't make sense, right? Jobs being added, unemployment going up. This could be a chart that describes what happened. So there's two different surveys that they figure out the employment, and they're not seeming to add up right now. They're not matching like they have in the past.
Yeah, so non-farm payrolls are up 2.6 million versus a year ago, but civilian employment, which is an alternative measure of jobs that includes small business startups, and is up the grand total of 195,000 jobs in the past year. That's not 195,000 per month. It's a total over the last 12 months. That's strange. Now, it's possible that one of the major reasons for this gap is the recent surge in immigration. Immigrants who get jobs at one of the companies included in the payroll survey, and it's a sample, it's not everybody, right? They're taking samples and extrapolating to the entire economy. So it's entirely possible that one of the major reasons that is because of immigration, if an immigrant gets a job at one of these companies that's included in the payroll survey, that should be counted because it's filled out by employers. But in civilian employment figures, the weaker one, the one that's only up 195,000 jobs over the last 12 months, are based on a survey of individual households. And it's hard to survey households in the US that are brand new or a little bit skittish about filling out a government form.
If you're not supposed to be here legally, you're not going to fill out a government survey.
Probably not. Okay. And the other thing is that we're seeing that growth in jobs, because jobs are not people that are employed.
Full-time salaried people.
Jobs are job openings that are filled and held at these survey companies. And what we're still seeing is that there is a drop in full-time employment. We've been seeing that since February. That continues to drop, and that more people are working multiple jobs.
Right.
So job growth may be going up, but it's not a greater number of people working. It's fewer people working more jobs.
Two bad jobs doesn't make up for one good job, essentially.
Probably not. Yeah. Okay. So let's talk about housing a little bit. I know that's been on the mind. We see a lot of our sale signs.
People are worried about housing. I know in my neighborhood, there's a lot of houses that have been on the market for a long time. This chart shows the existing home sales adjusted, of course, in the millions. And we can see what's happened in the last year and a half. It's kind of moved sideways. And then this year, particularly, it is dropping.
Yeah. And so homes are staying on the market longer, and the prices are beginning to fall a little bit as well.
This was a dramatic figure, though.
Yeah. New single-family home sales declined 11.3% in May. To a 0.6 million annual rate that was lagging the consensus. And then sales are down overall. These are new homes, down 16% from a year ago.
That's a lot.
So the realtors look at this and they look at the total months of supply. And so the months of supply of new homes, that's how long it would take to sell all the entire homes of inventory out there, rose to 9.3% in May. The gain was due in part because of the slower pace of sales and a pretty good sizable increase in the number of units that are available. The median price of new homes sold in May was $417,400. That's down a little bit, almost 1% from a year ago. The average price of new homes sold was $520,000. That's up about 4.9%. So you're seeing the extremes pushing up.
So
the
there's so much supply available, yet the prices don't seem to be going down quite yet.
Yeah, and there's just new builders are not building as many new homes right now.
Mm-hmm.
All right, so as usual, we talk about the yield curve. This is the treasuries and treasury bonds and T-bills and things. And you can still see the treasury yield curve is still inverted.
This is month 28 of inverted yield curve,
Right.
2.5 years.
Historically, that's been a precursor to a recession. Obviously, it hasn't happened yet, but we've been there a long time. And we still see the 1 month yield is just below 5.5%, while the 30 yield is around 4.65. So we haven't seen a lot of change here. We'll see if when the Federal Reserve does decide to cut rates, if we see that shift and flip, but that remains to be seen.
This shows the 10-year yield over the past 2 years. We can see the peak there in October of 2023, and it felt like things were really changing for the better and moving down. In December, Christmas time of last year, we saw rates as low as 3.8%, which we would love for them to stay down there, but look, since then, they've been creeping their way up.
Yep, 4.6% as of the end of May. And so that's significant. That's going to impact borrowing costs. And
this really will impact your budget.
Yeah. All right. So let's talk about presidential elections. If you didn't happen to listen last time, it may be time to revisit that. So this is a chart going back all the way to 1928. And it's looking at every presidential election cycle and the relative performance of the stock market during that time. Okay. So what you're seeing here is there are only four times did the markets fall in a presidential election year. The Great Depression, the beginning, right before the beginning of World War II for the U.S. involvement, the tech bubble burst in 2000, and then the Great Financial Crisis in 2008. All right. These are the only times that we've seen the market fall in these years. We get lots of feedback from clients and prospective clients that they're worried that their investment portfolio is going to crash because who gets elected?
Yeah, they say if so-and-so gets elected, I'm pulling my money out. Or if so-and-so gets elected, I'm putting everything in the market. And that's just not what we're saying is applicable here.
That's not good investment decision-making there. So I just wanted to show this again because it's very interesting. It's like, okay, in most years,
we're not saying that the S&P 500 is going to finish strong the rest of the year, but historically, there have been major events that have caused it to decline.
Right. You know, each of these years where the market declined, there was something other dramatic going on in the economy or global geopolitics that would cause those declines. So still got a lot of conflicting economic data. The market is rebounding, and hopefully that means we'll have a positive future, but it doesn't predict the future. And so what does it all mean? Well, we said before, we don't have a crystal ball. But we do know that these conditions, we could still see the potential of a recession in the future. And so what does that mean for you? Okay. Well,
these are really the same things that we've been worried about for the last couple of months. Inflation continues to rise, like we talked about. Market indexes are strong. We showed that earlier, but it's really just influenced by the AI and large cap situation going on right now. And bonds, of course, are not the same story.
Yeah, interest rates are still high. Credit card debt is rising, meaning that households are having to turn to their credit cards in order to make ends meet. This is not showing data that says that people are making big purchases and we're just deciding to finance it. People are putting a debt on their credit cards just to make ends meet. That is a potential problem for the road ahead.
Mm-hmm.
Okay.
As we said, with the political election and every presidential election in full swing, just please avoid making political bias in your financial decisions. As much as it feels right to make a dramatic decision based on what's happening in this situation that we have right now, avoid it.
And that's the thing we try to remind people of. Whenever there's a lot of confusing things that are going on, rely on data. Don't rely on emotions. You rely on emotions, you're more likely to make mistakes.
And also talk to your trusted financial professional. They
Yeah.
know what's going on.
Well, most of them do.
Most of them do.
So what about your 401k? Many listeners have a large portion of their wealth held inside their workplace retirement plans. We've got some new services out there that'll help you manage that a little bit better, I think, than the automated computer-generated allocation things that people do.
That goes for every company. I don't care if you work for the biggest company or the smallest company, we can use this new tool and hopefully bring you some peace of mind of what a big portion of your net worth is doing.
Yeah, in fact, that tool made changes yesterday.
Yeah.
Even with the market going strong as it is right now for large caps. So it's some unique tools that we can share with you. If you want to talk to us about that, you can reach out at 254-282-0495. Okay, so hey, half the year is gone. What does that mean? You just need to take action with your financial journey. And that means look at your performance, look at your statements, see how you're doing relative overall. Are you outperforming the benchmarks that you should be comparing yourself to?
Unless you have all of your net worth tied up in the NASDAQ, you're probably not going to see 18% growth this year.
No, you're not, but you'll see good growth.
Yeah.
And that is a positive. I think people try to chase returns, and that's where they get in trouble because things like the NASDAQ index are extremely volatile. And remember, the NASDAQ went down by 36% in 2022,
Right.
the S&P by 26%. So don't chase those returns. Check your statements. Talk to a professional. If you don't have a financial advisor, you can reach out to us and we'd be glad to talk to you. So Jesse, I'm going to check and see if there's any questions on the board. Sometimes we have some, sometimes we don't.
As always here, you can visit our website to learn more about us. You can send us an email at info@clearvistafinancial.com. That text line again, if you ever want it, is 254-282-0495. If you have a big question, small question, you just want to say hi.
Okay, folks, we're wrapping up our show today. Feel free to reach out to us anytime. And we hope that you have a pleasant July. We'll be back on our normal schedule for August. We will have this program the first Thursday of August, which I think is that August 1st. I can't remember, maybe August 2nd. And we hope that if you'll give us some feedback when we end the program here, that will launch a little survey. If you'd like to reach out to us, you can. And folks, we look forward to seeing you next time here on the ClearVista Financial Annual Update. Thanks for joining us.